Watching the newsroom right here on ET Now. I'm Ajay Sharma. The first half of the session for a third day in a row is in actually a very narrow range. Within the market, you will see Bank Nifty is doing way better than the Nifty, but overall, it is appearing to give one an impression that market is getting tired, meandering around the same levels for almost 3 days. Let's take the discussion on markets forward. What exactly is happening? Is it the lack of cues, earnings season being over? What will move the market, and what are the factors on which the market will actually depend on from here on? We have a very special guest who is joining us. Rahul Baijal of HDFC AMC is here with us to chat more about markets. Rahul, thank you very much for your time. Good to have you on the show today. Rahul, what are the key monitorables in your view right now? There is a section of the market who believe that CPI indeed, US as well as India, has rolled over and the direction is lower. But then the other section believes, no, it will be sticky for long. It will not be that easy and market may have run ahead of fundamentals. Which side of the argument do you stand?
Yeah, thanks Ajay for having me here. I think there are two big macro variables which are important for the equity market going forward. And I think locally, globally, especially in the US, the focus of investors are on these two variables. Firstly, it's the inflation peak timing and therefore the Fed rate peak timing or the local repo rate peak timing. I think on that front, there is some more comfort coming given the last few weeks data coming in. So the risk off which was happening in the market on the back of that variable, I think seems to be tapering off a bit. But the second variable is the impact of the slowdown ahead, how long, how intense it's going to be in the West, and therefore implications for emerging markets like India. I think the debate on that is still out, and it will take about 3 to 6 months for clarity to emerge on that front. So from a market perspective, I think on the first leg, there is some more clarity which has come out. The second leg, I think, will keep throwing some uncertainty. And from that perspective, my sense is short term, the chances are high that we probably remain in a consolidation mode.
Okay, that is one thing. Rahul, how are you approaching the, within the composition of the market in terms of earnings quality? Where do you find most robust earnings quality? And then we come to whether the valuations are pricing it in or not. But let's talk about the earnings quality and the trajectory of earnings from your observations of this earnings season gone by and commentary.
Sure. So if you look at the earnings season gone by, it's been a mixed season. Some sectors have clearly surprised and delivered on earnings. Clearly, banking is the top of the pack over there. Then even IT, on margin front was a positive surprise. On the consumption front, we have seen the high-end consumption earnings quality being good. So stocks position in those plays. Whereas mass consumption still seems to be having, a soft patch, which has been the case for more than a year now. So I think it's a mixed bag. Banking is looking good. High-end consumption is looking good. There are parts of the auto sector, like the CV cycle, the passenger vehicle cycle, which is looking good. And there are pockets in the domestic private sector capex cycle where earnings quality is looking good. So that's an area where I think, earnings quality is looking good. On the other hand, there is some soft patch clearly in mass consumption, as we can see in two-wheelers and many FMCG businesses, the way they're reporting the performance. So I think over there, some softness continues. Even metals, which are more linked to the global cycles, clearly the soft patch continues. So I think it's a mixed bag out there.
Right. I wanted to, take your understanding on the broader end of the markets, the small cap and the mid cap end of the market versus the large cap, only on valuation froth, terms, because that particular end of the market sometimes gets ahead of the fundamental, sometimes get too compressed, people are missing it on. How do you see purely the valuation argument on broader markets right now versus the benchmarks?
Sure. I think, Ajay, the valuation froth to a great extent has been taken out across asset classes. Even in equities, if you look at the kind of correction we have seen in global technology space, even locally, if you see the kind of correction we have seen, broader market, like you mentioned, had pockets of euphoria. And again, I think, given the last 1 year of corrective phase, a lot of valuation fraud at least seems to have been taken out across many mid and small cap names. So I'm in the camp which believes that, as far as valuations are concerned, after a prolonged corrective phase over the last 1 year, a lot of valuation fraud has actually been taken out.
Rahul, how concerned are you on the global slowdown? Because, around 40% of Nifty earnings are global in nature. Even in the broader market, sector after sector, who actually, particularly Europe, the exposure to Europe, Balkrishna, voiced it nicely. I'm just taking names for example purposes. Some of the agrochemical players also voiced it. But the fact is that Europe is melting away on the economy front, particularly Germany. How will that actually impact the overall earnings for a vast area of Indian corporate India who actually does business with that region?
Very valid concern, Ajay. I think, like I mentioned, the extent and the intensity of the slowdown ahead in the West is a key monitorable for the macro behavior of the markets. And I think Europe probably has bigger problems versus what's happening in the US. The underlying strength of the US economy looks pretty good to me. So my sense is that India, which has a higher correlation as far as the economic performance is concerned, and even the market performance with the US markets, there is clearly higher correlation over there. My sense is that US probably will, manage to come out of this much easier. But I agree with you. Europe is where probably the bigger problem lies, and many manufacturing companies which have export linkages to Europe, will have a hard time in the slowdown ahead. So clearly, stock picking on the exports front has to be very careful, and one has to keep this European-US slowdown in perspective while building portfolios over the next 1 year clearly.
Rahul, you must have stress tested your portfolio over the last few weeks, I'm sure, after the earnings are done. A 12-month, 24-month far out, what comfort are you getting on the earnings, on a blended earnings part of your portfolio after discounting some of it?
See, we keep doing stress testing regularly in terms of 1 year forward, 2 year forward earnings. I think at the end of this earnings season, like I said, it's been a mixed bag. There has been clearly some reinforcement in the overhead positions I've been running in terms of sector calls, and clearly more of a negative reinforcement in some of the underweight bets. So while this is an ongoing exercise, I think in terms of 2 year forward, I guess it's still a bit too early. Like I said, next 6 to 12 months is where the focus in terms of the slowdown lies. And we have done some stress testing, and the current portfolio construction in terms of direction of overweight and underweight is building in some sort of a slowdown, which we are expecting, and the implications for the relevant stocks and the sector positioning in the funds.
All right, Rahul, we'll let you go on that one. Thanks so much for your time today. Look forward to having you more often on the channel from here on. Thank you so much for your time today.